Disclaimer. Be aware that neither Market Chameleon, Demetri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, good Tuesday morning, D, election day.
Good morning, Will. How are you?
Good.
Yep. Let me share my screen. Good morning, everyone. And I'm gonna come back to the screener that we've been working on for the last couple of days. And what this screener does and looks at historical earnings for stocks and then uh, looks at different strategies around earnings. Uh, and it could be different date ranges as well. So I'm just going to kind of just recap what this does, and then we're going to perform actual screens and look at results. So if you are joining us for the first time, this screener looks at the historical earnings for those stocks that are available to have earnings. And the idea here is it says, okay, there are different types of strategies you could use around earnings. You could use a straddle, you could use a strangle, you could do a call spread, put spread, you know, just the call or just the put, for example. And it keeps track of how those strategies performed and then creates summary statistics. Was there any particular strategy that did better than others? Um, you know, what was the performance like, and so forth. And then you could compare those versus other strategy, compare strategies versus each other or in different stocks. So what we're going to do is, come up with a thesis, and then we're going to screen for that thesis and see, like, hypothetically, how, how did the markets perform relative to what we created an expectation in our mind, right? And let's say, and I'm just going to make this up as I go along, okay? But let's say we have a thesis that uh, on you know on average stocks, they're going to have up moves, they're going to have down moves, but on average, if you look at earnings, over many periods, they're going to have more up moves than down moves. Okay. And that when they have up moves, they could be just as violent to the upside than downside. So given that theory, we'll say, okay, if we one bullish strategy is just buying a call, an at the money call right before earnings and holding into the next day, giving it a full days of movement after earnings to price in that information and event. And the theory is that we're gonna win some, we're gonna lose some, but on average, it would be a winner over, many periods. Okay, so let's take a look at that theory, and then we're going to look at the top market cap stocks. So first, let's pick the strategy that we just talked about. So under here, strategy, we're going to look at single options. Instead of a 25 delta call long, we're going to say we're looking at an at the money, long at the money call. So it's going to be an at the money call that covers that earnings, with the shortest dated option that covers earnings that day. So that's what we're going to look at. So I'm going to first select long at the money call.
Hey, D, we
Yep.
do have some new people. They're asking how you get to the screener.
So up here where there are the main menu under earnings. Okay, when you hover over it, you go over here and it says earnings option strategy. Click on that and you'll end up on the screen. And so once you're here, what we did was first select the strategy we're interested in. And this is a long at the money call strategy, right? You find the strike that's the closest to at the money, and if you buy that call, that's your position. You're long in at the money call. So now that we have this, you could see that all of a sudden up here we have symbols, market cap of the stock, and then the strategy now is long at the money call. All of them are long at the money call. So we also measure different dates around earnings, because you might have a theory of, stock running up into earnings, stock doing something after earnings, maybe 1 day before, 2 days. But let's just keep this particular hypothesis for the time frame is right before the stock announces earnings to the end of day the next day after announces earnings. So our historical open range would be the 1 day before the announcement. All right, so when we click on that, 1 day before the announcement, you could see the historical open range now is 1 day before. Okay, so now we picked long at the money call and 1 day before, and we want to close it end of day after earnings. So the historical close range here is day of earnings. Okay, so this would be end of day of earnings. We click that, and now we have it all set up. Long at the money call, 1 day, starting 1 day before, and closing out end of day of earnings. And what I'm going to do is I'm going to sort this by market cap, because we're interested maybe in the highest market cap stocks right now. Okay, let's look at. So I'm going to sort this by market cap. And now you could see here, Apple, Nvidia, Microsoft, Google, Amazon, Meta, they're up here. So let's look at these stats here. So over here in the last 12 observations, so 12 observations are 12 quarters. We have earnings, four times a year, 4 quarters. So this would be 3 years of data. We don't have more than that because earnings don't happen once a month, every day. That's the data we have available. And according to this, and we could look at the data by clicking on this 12, but let's just look at the summary statistics. So it says half the time this call was profitable, half the time it was unprofitable. Okay, so a call, keep in mind, could be unprofitable. Even if the stock goes up, if it doesn't go up by enough, the premium could come in, because if it's a small move and the day before the call's priced for a larger move, then the next day the call price can lose its value. The stock could be unchanged, the stock could be down. So there's different scenarios. So, but half the time it looks like it was profitable. So it's like 50-50. So the next question is, even if it's 50-50, 40-60, whatever it is, 36, a call, keep in mind that if you're long a call, your risk is whatever you paid for it, right? That's your risk. But your reward could be anything. It could be double, it could be triple, it could be quadruple, whatever it is, right? So even at a 50-50, it could still be a profitable strategy. Like, think about flipping a coin. If you flip a coin, let's say 50-50, well, if you lose $1. But if you win $2. Well, that's a positive expected return, right? So how did this call do? I mean, how did the strategy do? So here it says, on average, if we took all the outcomes, the return was positive 20%. So still, even though the frequency of wins versus losses were 50-50, the average return of all of them was positive 20%. Right? So that's pretty good. What about the median return? So the average could get skewed up. You could have had one like really big one that took the average all the way up. So what if we just split the returns in half and said half of the returns were above this, half the returns were below this? Well, that's the median return. You can see it's negative 13%. So there are more negatives here, in the median than in the positives, right? So the average did get skewed. So let's take a look at the best and worst, right? What about the range? Like what's the most the strategy made at any given time? What's the worst? So here you could see the best return was positive 200%. So not double, it's like triple, right? If it was worth $1 worth through. The worst is negative 100%. So all of it, right? So there are probably times you bought a call, the stock was down, and the call at the end of the day could be worthless. Um, so that's so now we're getting kind of an idea about this strategy. Yes, it's risky. You're gonna have lots of losses, some gains, but historically and but on average, it still came out with a positive return. What about the standard deviation of those returns? Because how much risk is there in these strategies? Because you could see here the range is plus 200%, minus 100%, so they could be anywhere. So this is the standard deviation, 127. So if we divide the average return by the standard deviation, kind of normalize it based on return for the unit of risk, Sharpe ratio is 0.16. So the higher this is, the better, right? Because you want a low standard deviation and a high expected return. In other words, if it was each time 20%, 20%, 20%, 20%, well, that's a great return for very low variability. And now we have this in front of us, and we could see, well, what about, since we sorted it, are the other stocks similar? So we could see here, there's variability. NVIDIA did better, Microsoft, not so much. That one was negative. Amazon did a little bit better on average. Meta did a little bit better, but you could see here now how that theory played out. Even if it looks like if you just did that strategy in all the top market cap stocks, on average, it would have been profitable, but you'd have to be able to bankroll, that type of strategy as well, because you're gonna incur losses. You're gonna have maybe entire quarters worth all losses. It could be so this is a strategy, that if it stays this way, the distribution of return stays this way over the long term, looks like a potentially, here's even Tesla. Look, you can see Tesla, the frequency of wins was very much lower, 33%. Only a third of them, the calls ended up being profitable. But on average, it still came out with a positive 25% return because you had a call that gained 465% one time. So, on the surface, it looks like it's in a long term, it looks like that if this stays consistently like this, or the future looks anything similar to it, yeah, it's a positive strategy, even, maybe even like a decent return, but there's a lot of risk and variability, and you'd have to have pretty deep pockets to bankroll this. That's what it looks like. Okay. Let's see if we could look at anything else. What about if our theory is that on average, these stocks tend to run up into earnings like a week before. So maybe there's less variability and a higher win rate and better average returns because, if it's, the call may not lose as much value, right? If you can get out of it right before earnings, it could decay if the price goes down, it could lose value. But let's test that theory out. Maybe that the run up into earnings is better than just holding that call around earnings. So let's test that theory. I'm going to come up here. I'm going to change this date range. We're going to go 1 week before. And then, so we see this change. And then let's say the day before earnings. That could be a strategy. I don't need to, you don't need to hold it around earnings, right? You're just looking for the strategy that makes sense. So here, okay, this looks a little bit different here. The Apple, Nvidia, 42% win rate, average return 0, 42% Nvidia, negative. Google looks a little, positive, Amazon. So maybe that theory of, historical run-ups in this large cap stocks, that it was a theory, hypothesis, but from a historical perspective, doesn't, it doesn't, kind of align with that hypothesis theory, as we eyeball it. We could also do a different theory. Maybe after earnings, there's a run-up. Maybe people, get into these high-tech stocks after their earnings. Let's say we're looking at 1 week after earnings, and the 1 day after. Right. So we're doing now is saying, all right, forget about the uh let's say the earnings event happened, and maybe that's when the call could be undervalued. So we're testing this theory, and as you can see here, a couple of them, look positive. So it's a mixed bag too. So far, just out of those theories, it looked like maybe that strategy day before versus day after in our analysis looked like the most promising from the historical perspective, but a lot of variability. It would probably take lots of trades, to get that profitable, and the future would have to look similar to the past. So that's another theory. That's also an assumption that may not hold true. So let's change the strategy. I mean, longer call is it's a little bit riskier too. Maybe we could change that assumption, the strategy, and let's say we're looking for a time spread. Maybe that would work better. What if we did selling the at the money call and buying an at the money call at a different month? Assuming that strategy, once earnings are released, the next day implied volatility comes in, and maybe that strategy worked better. Let's test that out. So I'm going to come up here. I'm going to change the strategy now. And let's go to what did I say? Time spread, right? So here's a time spread. There are different ones. Let's look at an at the money calendar spread, at the money call calendar spread, selling the near term, buying the further out, right? So I'm changing the strategy now. So click on that. So you can see here the strategy changed, right? Calendar call spread, at the money, selling near term, buying further, because you're doing two different months. And let's change this back to around earnings. So let's say we do this 1 day before the earnings. That's the historical open. And end of day after earnings. Okay. End of day after earnings. So here we have, let me see why this. One sec. Let me just see why I didn't capture some of these. Let me just look at if it's the number of observations. One sec, guys. Okay. So I had to change the number of observations historically because when we look at the historical database, you could see here NVIDIA, we couldn't get 12 observations. Microsoft, we couldn't get 12 observations. We only had 10. And in the last 3 years, the reason that could happen is that if the stock is in a place where it's not close enough to an at the money, we can't use that as an observation, right? Or if the options are not lined up with this particular spread, then we can't use it if it's too far away. So in this instance, you could see in Microsoft, we only have 10 observations, Google, and so forth. So let's see what happened in NVIDIA, the top one. So NVIDIA, the strategy was a winner 64% of the time historically, but the average return was 4%. The median return was 9%. And you could see here the best and worst return, 63% best, 63% worst, lower standard deviation. So even though we had a little bit higher win rate and a lower standard deviation, you could see that the average returns were much still positive, but much lower. Same thing with Microsoft, bigger win rate, but average return is a little bit lower, but you also have a lower standard deviation. If we take the average return versus standard deviation, it looks like a 0.32. Google, that looked like a loser. So selling an at the money call in the near term, buying it out in the further out, that was only a winner 30% of the time. 70% of the time it was a loser for an average loss of 14%. So if you just wanted to see that, we could click on the observations. So you see I clicked on that number, observations. You could see this is the strategy. So here we go, October 29th. So July 23rd, you could see the next expiration. I'm sorry, the earnings, but this is blank. The reason we don't have an observation there is that the stock price was not near the at the monies, so we couldn't use that observation. Wasn't close enough. But here we could see October 29th earnings. The expiration we looked at the first month, November 1st. So this would be selling that the money call, right, on the 170 strike. So this was the option right before 630, 650. After earnings, it was 635, 655. So almost like in the same spot, right? I would say almost a little bit higher, right? Maybe 5 cents higher. What about the further out? So the further out, you could see the price before was 815, 825. It went up to 890, 975. So this was a dollar total gain, 59% return. And this is what the stock did. It went from 171.22 to 176. So it was up 2.8%. Okay. So that was the stock reaction, and the option strategy in this case was up 59%. Okay. And these are the other observations. So you could see that, there were times the strategy lost 48%, 54, 78, and this is what the stock did. So this is just a quicker way to look at different theses, as long as it's in a screener, and test it out and see what did these strategies, how did they perform in a 3-year period. So we're right up at the end, Will. I'm going to stop right there.
Yeah, that's great, G.
Yeah.
Just so everyone knows, I was about to put it in the chat, but we have an IBKR webinar next week on Tuesday, 2 p.m. It's our monthly series. We actually had a new Chameleon today, D, who was asking best way to get started looking at the Chameleon. He's a newer participant, and Rob advised some things on the site. There's a great spot to go for videos where I put a link, but these IBKR webinars is also a large library of webinars Demetri has done with interactive brokers, and those are all on IBKR sites. So follow that link through, and there's an IBKR video library as well. So I'll put that in the YouTube chat. Great job, D, as always, my friend.
All right. Thanks, everyone. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Trading peace, chameleons, everyone.